This is the luxury world. Get inspired with us today and tomorrow. In recent years, the luxury watch industry has undergone a dramatic transformation, particularly in the realm of pre-owned and gray market sales. What was once considered a thriving parallel ecosystem, fueled by speculation, scarcity, and unchecked premiums, has now entered a prolonged state of contraction. The gray market for Rolex watches, once a lucrative arena for resellers and flippers, now finds itself unraveling at an accelerated pace. While economic headwinds have contributed to this decline, the true catalyst appears to be the brand itself. Rolex did not merely withstand the market's implosion. It took active measures that resembled a deliberate and controlled demolition of the very speculative framework that had emerged around its timepieces. To fully understand the gravity of this collapse, it is necessary to revisit the market conditions that led to the speculative surge, and that is what we are about to discuss in this video brought to you by the Luxury World. Please subscribe to Luxury World for exclusive access to upcoming insights, curated content, and expert guidance to help elevate every step of your watch investment journey. In early 2022, Rolex watches, particularly steel sports models, were being resold for multiples of their original retail prices. The Daytona, Submariner, and GMT Master II were among the most coveted references, often selling for double or even triple their retail value. These premiums were driven not by intrinsic value or limited edition status, but by a perceived and manufactured scarcity. The gray market, which operates legally but outside authorized dealership networks, has become a hotbed of speculative activity. This period of excess was not without cause. It was propelled by a unique convergence of external factors that created a near-perfect storm for luxury goods inflation. Global stimulus measures, introduced during the pandemic, injected significant liquidity into households. Simultaneously, restrictions on travel, entertainment, and dining redirected consumer spending toward tangible assets. Luxury watches, and Rolex in particular, emerged as a preferred store of value for many consumers seeking both financial preservation and status signaling. A new generation of buyers entered the space, driven by profits from cryptocurrency and speculative equities. With newfound wealth and an aversion to traditional financial institutions, these individuals turned to Rolex watches as both wearable assets and digital trophies. The influence of social media platforms cannot be overstated. Watch-focused content proliferated across Instagram, YouTube, and TikTok, portraying Rolex ownership as a benchmark of success and wealth. The resulting demand created an artificial scarcity that drove prices to unsustainable heights. By mid-2022, the market had reached levels that were detached from reality. The stainless steel Daytona commanded premiums up to $34,000 above its retail price. The GMT Master II Pepsi was reselling for nearly $19,000 over retail. These figures represented more than appreciation. They reflected irrational exuberance. The market had ceased functioning as a collector's space and had transformed into a casino where rapid profits eclipsed horological appreciation. The correction, when it arrived, was swift and unforgiving. Rolex's secondary market index fell by over 30% from its peak, erasing nearly all of the gains made during the post-pandemic boom. Models that had once been considered bulletproof stores of value were now trading below their acquisition costs. The Daytona dropped from its $50,000 high to approximately $32,000. The Submariner Hulk, another darling of the gray market, declined from around $30,000 to below $20,000. What was initially perceived as a market adjustment quickly became a rout. The first move came in the form of the Certified Pre-Owned CPO program. Launched in late 2022, this initiative marked Rolex's official entry into the second-hand market. Partnering with select authorized dealers, the brand began offering pre-owned watches that had been inspected, authenticated, and issued with a Rolex-backed 2-year warranty. This shift was seismic. For decades, Rolex had allowed the gray market to flourish unchecked. Now, it positioned itself as a direct competitor to the very networks that had profited from its scarcity. The CPO program offered more than just certified watches. It delivered peace of mind, brand validation, and after-sales support that independent resellers could not match. For the consumer, the value proposition has shifted dramatically. Paying a premium for a used Rolex on the gray market no longer made sense when similar models could be purchased with factory endorsement and official servicing guarantees. This move redirected resale profits from independent dealers back into the official Rolex ecosystem, undermining one of the gray market's core advantages. The second strategic intervention came through Rolex's announcement of a new $1 billion manufacturing facility. This expansion signaled a clear intent to increase long-term production capacity. While such an initiative would take years to bear fruit, the announcement alone sent a powerful message. The illusion of eternal scarcity, long the foundation of the brand's resale premiums, was being challenged. For decades, Rolex had maintained an air of unattainability, with demand consistently outstripping supply. By telegraphing future growth in output, the brand disrupted that narrative and introduced the idea that availability might one day improve. The third prong of Rolex's strategy was more subtle, but equally devastating to speculators. Even as secondary market prices began to fall, Rolex continued its practice of annual retail price increases. This inflationary approach, in the midst of a resale downturn, served to compress profit margins for flippers. A model that once provided a $15,000 spread above retail might now offer only $5,000, or even less. The combination of rising acquisition costs and falling resale values rendered flipping increasingly unattractive. This gradual tightening of the resale ecosystem effectively choked off the gray market's supply chain. Flippers, once incentivized to queue at boutiques and cultivate dealer relationships purely for arbitrage, began to exit the space. The risk-reward calculus no longer made sense. With smaller margins and slower turnover, the effort and capital required to sustain flipping operations became untenable. The consequences of this shift are already visible. Many gray market dealers are now holding inventory that was purchased at 2022's peak, with resale values that no longer justify acquisition costs. These assets, once considered safe bets, have become financial liabilities. The pressure of rising retail prices, declining consumer demand, and increasing competition from Rolex's own CPO program is pushing many independent dealers toward insolvency or radical repricing strategies. The very foundations of their business model, artificial scarcity and speculative resale, have eroded. At the same time, the correction has benefited collectors and genuine enthusiasts. The most egregious premiums have faded, and access to models through authorized channels is gradually improving. Waitlists, once mythical in duration, are reportedly shortening. The emotional and financial barrier to ownership has decreased, shifting power back toward the end consumer. The watch buying experience is becoming more transparent and less transactional. More importantly, the nature of watch ownership is evolving. With speculative fervor subdued, collecting is once again being driven by passion, not profit. Consumers are increasingly acquiring timepieces to wear and appreciate, not to flip. This signals a broader return to the core values that luxury watchmaking was built upon: craftsmanship, heritage, and enduring style. The frenzy of recent years, though profitable for some, distorted the market in ways that undermined its integrity. This new market structure reflects a deeper truth. The speculative era of modern Rolex flipping is over. The circumstances that allowed it to flourish, easy money, scarcity narratives, social media hype, and unchecked margins, have been systematically dismantled. Rolex did not merely survive the storm. It managed and redirected it. Through calculated strategy, the brand reclaimed its image, protected its long-term value proposition, and dismantled a parallel economy that had grown dangerously large. What unfolds now is a more rational, more sustainable luxury watch ecosystem. For speculators, this new reality marks the end of a chapter. For collectors, it may be the beginning of a more grounded and rewarding era in horology. What are your thoughts on the shifting dynamics of the Rolex market? The luxury watch landscape is undergoing a significant transformation, and informed perspectives are more valuable than ever. We would love to hear your perspective. Feel free to share your thoughts in the comments and give the video a thumbs up if you found it insightful. Do not forget to follow Luxury World for more curated content on fine timepieces and market insights. Thank you for watching, and we look forward to welcoming you again in our next video.